Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Adore Beauty, ticker is ABY, price at the point of filing is $1.40. Let's get right into it. This is not a recommendation or advice. Please do your own diligence before investing into anything. And please write down in the comments below if you have invested, will invest, or why not into Adore Beauty. Description: Adore Beauty is a leading beauty and personal care BPC e-commerce company in Australia. It was co-founded in 1999 by wife and husband Kate Morris and James Hyde. It grew revenue from $9 million in 2015 to $120 million in 2020. It had its IPO in late 2020 and the shares are down 80% since then. Nonetheless, we think Adore has a great long-term growth outlook given the immaturity of online BPC in Australia, combined with Adore's very strong brand perception with Australian BPC consumers. Adore is also already profitable, has net cash on its balance sheet, and trades at only at an 0.5x sales. If you believe in e-commerce, we think this is a great setup. A cheap, profitable e-commerce pure play with what looks to us like a long growth runway. If you don't, well, read no further. We've kept the write-up very to the point because we think the situation is fairly simple. Reasons for excellent growth outlook. Number one, Adore is by far the leader in pure play BPC e-commerce in Australia. Its two primary competitors in BPC overall are not e-commerce pure plays, but Mecca and Sephora Australia, both of whom started in brick and mortar but have become very capable multi-channel competitors. Both file financials with the Australian regulators despite being private companies, but neither discloses its split of online revenue. Though Mecca's CEO disclosed e-commerce as 15% of sales in 2019, meaning its business was smaller than Adore's at the time. Second, Adore is well known and well liked by the Australian BPC consumer, making it a leading destination for beauty product purchase and discovery. It has the third BPC website, the number one among online-only retailers, highest organic traffic share, and the number two mobile app after Sephora, as well as the number two beauty podcast in Australia. It's the only publisher with 3 podcasts in the top 20 in the fashion and beauty category. In 2021, it reported a net promoter score of 82. Third, Australia significantly lags developed countries such as the US and UK in an online penetration of BBC, but will surely catch up over time, generating a strong tailwind for BPC e-commerce in Australia. Fourth, additional opportunities for growth include their recently launched mobile app and owned brand products, as well as expansion into adjacent categories. From a financial perspective, the most meaningful of these is likely to be the owned brands, Viviology and AB Labs, because owned products generate much higher margins than the core retail business does, low 30%-ish gross. Viviology and AB Labs have only recently launched, with the effort being spearheaded by Kate Morris herself. Number one, leadership in niche categories of e-commerce is an attractive price to win, as it allows businesses to scale very quickly to substantial size. As an example, Wayfair grew its revenue at a 42% CAGR from 2013 to 2021, and Temple & Webster, the Australian Wayfair, grew 53% annually over that period. Chewy, which sells pet goods, grew 44% from 2017 to 2021. So far, Adore has fit right in with this trend, growing 48% annually over the past 5 years, including the COVID boom and subsequent bust. One possible pushback is that one could argue these track records were created at a time when brick-and-mortar incumbents were clueless about e-commerce, so share was easy to win. Whereas now retailers are better at competing online, so market share gains will be harder for disruptors to come by. Our retort would be that Adore's revenue growth to date suggests it is doing just fine taking share. Second, Adore's history as a profitable company makes its long-term EBITDA margin target of 10% plus look reasonable. The company has averaged an EBITDA margin, not adjusted, of 3% in recent years, despite being in hyper growth phase. The company was bootstrapped by its founders and has been run for cash flow break even for essentially all of its history. So we don't think a huge cut in growth expenses or a massive leap in sales are required for Adore to generate respectable profits. Adore is extremely cheap, currently trading at 0.5x sales, which would equate to 5x EBITDA at a 10% margin. Obviously, the EBITDA margin target is long term, and so 5+ years away. But at the same time, revenue is almost guaranteed to be dramatically higher. Third, incentivized insiders with substantial ownership. Kate Morris and James Hyde, Adore's founders, each own 11% of the company, with neither having sold a share since the IPO. And though neither is CEO, both remain actively involved in the day-to-day operations of the company. Kate in own brands and James as the company's chief data officer. Fourth, $30 million of net cash and break-even operations mean the company is in a very stable financial position. Issues. Number one, COVID hangover, lockdowns in Australia drove a huge spike in new customers, and now the churn of those customers, typically between one third and one half of them in the first year, is overwhelmingly slower new customer additions. As a result, revenue for the June 2023 fiscal year is unlikely to grow substantially or at all. Nonetheless, we believe strongly that the long term growth prospects of the business are unchanged and remain very strong. Second, private equity ownership overhang from the company's PE partner, Quadrant, which still owns 30% plus of Adore and which has rumored to be interested in exiting its position at significantly higher prices. Third, co-founder divorce and CEO departure. Earlier this year, the co-founders Kate and James announced that they are divorcing after 24 years of marriage. Both are remaining at Adore, and we assume there will be minimal impact to the business, especially since the two work in different parts of the company. But this is an operational risk nonetheless. There's also some investor concern about what Kate's level of involvement in Adore is, given that she recently co founded a small PE fund along with an ex Quadrant partner to invest in growth stage private companies in Australia. Some evidence to the contrary are multiple press interviews she has done in Australia about Adore's new owned brands, whose launch has been spearheaded, and her routine availability for calls with us, and we presume other Adore investors. As we mentioned above, the co founders each own 11% of Adore and have not sold any shares since the IPO. In addition, the company's CEO, Teniel O'Shaughnessy, is leaving Adore 2023. We think very highly of her, and apparently we are not the only ones. She is being approached IDP Education, a company with a 7.7 billion market cap, over 5,000 employees, and the ability to pay her multiples of what Adore could. The incoming CEO, Tamerlan Morton, has 2 decades of experience in e-commerce in BPC, pet goods, and a few other areas. We don't have enough experience with her yet to give an opinion. Catalyst. Getting post the COVID boom hangover and good showing by new CEO. Margin improvements as revenue grows. Thank you very much for tuning in. See you next time. Please write down in the comments below what you think of this company. I think it is interesting, yet a growth company, which I'm less interested in than in value. But it seems to be very cheap at the moment. I will look further into it. The only thing is, I read more and more about how important CEOs or management actually is, and if it just changed. And we don't know much about the new management, then that's a no for me. But I would have to dig further, and maybe I can find out more about the management. So therefore, we'll keep it interesting.